when you start out as trend following and systems and rules and following prices, essentially, you kind of need to, it's better just to go ahead and turn your back totally on fundamentals and choose one over the other. I don't think it's going to be better to try to incorporate both. And basically what trend following, I think to some degree, I've heard this a lot, and I don't have a problem with it. I think it's kind of probably true, which is that there's so many fundamentals, they're almost impossible to decipher and know them all. The world is too large. And then a lot of these fundamentals, or most of them, or the most important ones, are sort of embedded in price. And so if you're just following the price, sure, you're going to be late getting in, late getting out, but it's the best and most objective way to ride these trends and at the same time make money and preserve capital.
Welcome to the Rose Show podcast. Thank you so much for joining us today, and welcome to Trend Following Plus Nothing. I'm here today with Jerry Parker. He's founder of Chesapeake Capital Corporation. They're a global investment manager headquartered in Richmond, Virginia, 1988. Focused, consistent, and single-minded. Those are some key words for trading. And you were also an original turtle trader, and I want to ask you about that, to tell us about that experience. And you have a 4-decade career, so we're so honored to have you here to share your brilliance with us. And your new ETF, TFPN, Trend Following Plus Nothing, and next generation liquid alt. And I hear those birds back there. I love it. We love it. Hopefully we'll be enchanted with some birds coming into our video today. So how you doing over there, Jerry?
I'm doing well. It's a great day here in Tampa, Florida. So thanks for having me on, and I'm excited. You're excited?
Yes.
I'm going to feed off your excitement, I'm sure, but don't let me get too out of control.
Oh, awesome. We like it when you get out of control, Jerry. So this is going to be great. So excited to talk about trend following. So let's start with your background. And there are over 35 years of systematic trading. And it goes back to the turtle days of 1983 and this turtle experiment with Eckhart and Dennis. Please tell us about that and your experiences with that.
So much to tell. It was a great experience. These guys that hired me, Richard Dennis and Bill Eckhart, genius traders, genius math, application of computers and back testing in 1983 was probably pretty rare. So they had it all in the experience, in the commodity markets, in the pits themselves. They would, Rich traded in the pits. So it was a great combination of systematic and math, and, statistics, and computers, and the actual real world of trading. So, but anyways, I was an accountant in an accounting firm, public accounting, and I desperately wanted to get away from that. And I happened to see an ad in the Wall Street Journal, like the fall of '83, and so Richard Dennis was going to hire people, teach them how to trade, give them money to trade. And so that's what I ended up doing. I applied. There was 1,000 people who applied in the first year, and they sent everyone a test, a true-false test. So I carried this test around for a while. I took my time and sent it back in and got an interview. I went to Chicago for the interview, ended up getting hired, and then I went back to Chicago in December of '83 for the training course. 2 or 3 weeks, I don't remember. Then January the 2nd or so, we started. With all this knowledge and all these rules, we started trading.
Wow! And this is where the trend following all began. Is this where you started with that whole strategies that you've based your career on?
Exactly. I was sort of into the trend following as a hobby, as I was in the accounting firm and trying to plot my exit strategy. I was very interested in trading, and I stumbled on the trend following in my early 20s, and I was like, oh yeah, this is great. This is fantastic. Everything about it I love. It's objective. It's you can apply it to a lot of markets, longs and shorts, lots of diversification. And I've quickly surmised, okay, so it all boils down to, if you're going to have more losses than wins, then are the big winners going to pay for the little losers? And I thought that was just brilliant. Charts and stuff. I loved it. So when I took the test, I was kind of crossing my fingers and hoping that they were trend followers as well. I didn't really know too much about Richard Dennis and his philosophy, but luckily I was correct. I did well on the test, and they wanted to hire me and other people who done, who had good resumes, but they wanted to hire a few people who all they had going for them, like me, probably was just doing well on the test. And some people they hired did poorly on the test, but they had other skills. And none of it was required. It was because they were going to teach us everything we needed to know. And then in some ways, they didn't want us to be too polluted with bad ideas and have to unwind all those ideas, So, and we got a great, mentoring relationship, and the course, and then managing the money for 4 years, and being in contact with them, and really being able to get them to answer questions for us, but really get the culture embedded inside of us. Every now and then we would have a meeting and give us some lectures and some tips on what we were doing right or wrong. And it was more than just getting the rules in a manual. It was that plus being with those guys and spending time with them and learning from them directly, which is just invaluable. I have this bad analogy of kind of like if you get a manual to be a Marine. I mean, you can't be but so good as a Marine if all you have is a manual. And so we had the manual, plus we had the basic training and the ups and downs with these mentors who were saying to us, follow the rules, do the right thing. It doesn't really matter if you lose money. Just over time, just practice doing the right things in the markets the way we've taught you. And then if we lost money, they would sometimes give us more money, which is just not the real world, not what clients are going to do. Clients will do the opposite. They will say, oh, if you have to cheat and not follow your rules, but you're going to make money, then fine, do that, because it's all about making money and not, so we had to really pretend incubator period there where we just were protected from the real world until we really got our wings and we could fly.
That is an amazing experience, Jerry. Just hearing you speak about that, you touched upon some key human emotions that are involved. Mindset is over 80% of trading and everything in life. And to remove that fear of loss, and even if you had those losses, you didn't have that pressure that you had to perform as much as most people feel, and you were able to lose, and then you were given more money. Like, wow. And I know with my kids and their schooling, when they're so stressed and worried about exams, they tend to do worse. But when I say, who cares, it doesn't matter, just pretend it's a practice exam, they do better. So it's removing that pressure is key. And what an experience, and being able to not only learn, but then you get to do the activity, which is key. It's always about the application. And then I love when you use the words of not polluting with your ideas. It's like you have a clean slate and you're not filled with all these biases and bad habits over time. It's like you have this paradigm and this core, and it's just amazing. I have to say, what an experience. This is exciting. Thank you so much for sharing that. Now, fast forward 1988, you go to Richmond, Virginia, and you found Chesapeake Capital. Tell us about that experience and how that evolved.
Well, that was the next chapter. I think it would have been much better for me in the long run to be able to stay there with Richard Dennis and Bill Eckhart for many, many more years. But that was not to be. They wanted to stop the Turtle program, end it. And so we were fully equipped, though, to meet this challenge. We had no idea that we would be so successful and raise billions of dollars, and the managed futures CTA trend following business would kind of explode, and we would be reaping those benefits. We were very confident, and we knew we were equipped well. We Oh, one of the most important things, of course, was a verifiable track record.
Mm-hmm.
So when you go out and meet people, it's a great story, but do you have anything to back it up? So we had a great track record for those 4 years. All the turtles is who I'm speaking of,
Mm-hmm.
not just me.
Mm-hmm.
And so we were able to take that track record. And I remember walking around Wall Street one day and just using payphones and trying to get in to see people. And I called up Merrill Lynch and the head of Merrill Lynch Managed Futures. And someone answered the phone and I said, may I speak to the head of Managed Futures? And they said, no. And I said, oh, I'm Jerry Parker and I'm one of the turtles. And then she comes back on the phone and she's like laughing and she goes, yeah, come on up. So we had Richard Dennis, we had that name in the story. And so all of this stuff opened up a lot of windows, and we had some really good success initially, some good partners and people who liked us and wanted to give us money. And we tended to be very flexible and very easy to do business with and had good performance. We probably had, first 10 years, we had a positive return every year, something like that. It was an inordinate amount of time where we made money every year for, a number of years in a row. And so to some degree, the initial experience was, well, Sharpe ratio or whatever, if you're making money for people all the time, they're going to really like that. And maybe, give you a break. Okay, so you have volatility, you have drawdowns, you have losing months, but these guys just are really consistent. And I think that's one of the hallmarks of what sort of a classic trend following, massively diversified classic trend following program can do. It's pretty consistent over a 12 to 18 month period.
Love that. You provide investors uncorrelated returns through consistency. And that's the key word. It's being consistent. You make a lot of money now, but then you lose it next time. That's not what you want. You want to build that wealth over time. And, I love your diversification across many asset classes and alternatives. And then of course, trend following is at the core. And it's a convex strategy. And like you said before, it's not about your hit ratio. It's more about the win-loss ratio. So really interesting thinking. And so I want to go into the mindset and the thinking, the foundation of trend following. And we have loss aversion bias. So right there, it's a simple but not easy thinking. Tell us about that with those small losses that are consistent.
Right. So I think Richard Dennis was really smart on wanting to develop systems and approaches that were counterintuitive to humans, that really didn't, was really hard to implement. The small losses, people like frequent positive feedback. And so we were getting frequent negative feedback and frequent big profits. A lot of small profits maybe, and 60% of the trades were losing trades, but then very infrequent outlier type moves that are going to pay for all those losses and make all the profit. So it's really a counterintuitive and very painful way of trading. So another thing too is, I think that is very painful, is making yourself follow those rules and being systematic. And the consistent application of these rules is really the key. He would often say, if you have an average strategy, your rules are not the best, then if you just apply those rules every time and never deviate, you're going to be so much better off than people who have the best rules, the best systematic approach, but they're a little shaky on not following the rules all the time. So consistent application, there's nothing more important. I tweeted yesterday something, I just get these things in my head sometimes, and I'm like, okay, you got to tweet this. And I'll usually get like 2 likes, but I don't care. I have to get it out of me, So it was something like, that's the most important rule, is that you're going to create rules and create a strategy that allows you to implement your rules all the time. So if you're trading too large and you're losing too much money, you may have to reduce your trading size, or you may have to not take some trades even possibly. And this is just death. You cannot do that. You have to, everything that you're trying to do, the very first commandment of the 10 commandments of trend following is you must devise this system so that you can afford and you're able to trade, to put all the trades on the same way all the time for the rest of your life. Because the computer, you've asked the computer, how does this system perform? How do these rules perform historically? Just go ahead and apply these rules over the last 30 or 40 years worth of data. And the computer says, well, if you did those every single time over the past 30 or 40 years, you're going to make good money. You're onto something. Well, then it's up to you to carry it forward for the next part of your life. You can change a bit, you're going to have to tweak things, change things. And once you do, then you start again. I'm going to do the same thing forever. But if you trade too large and if you risk too much, it kind of plays into you're not only losing money, but you're making it very, very difficult psychologically and financially to keep going with doing the same thing, following those same rules. So that's why it's a combination of trade small and follow the rules. It's so important. He would also say, if you skip a trade and don't do a trade, the chances are so high that it's going to be the one that makes all the money. So these are sort of core principles that I have never forgotten. And thankfully, when I have not implemented those ideas and I have made mistakes and not followed the rules, I've been punished dearly for them. So I have no fun stories about not following the rules, only sad stories.
You touch upon some excellent points, and I love our little friend joined us for this discussion. I guess he or she agrees consistency in following your rules is key. And, a lot of traders talk about that they broke a rule and it helped them in this time, but long term, it always hurts you. Agree, absolutely. Following these rules are most important. And like you said, they evolve over time. You tweak and you modify as you learn and grow, but it's important to follow these rules. Jerry, I have to ask you, how did you remain so disciplined and consistent and avoid those emotions attached to seeing these consistent small losses?
I think it's primarily, once again, those formative years of learning the rules and being mentored directly by those guys, and not always following the rules, and so being kind of punished for that, and not having good performance sometimes because I didn't follow the rules. And then I think one of the things that happens to traders, really, I think the two most important rules, according to Rich, was trade small and follow your system. So I definitely did not always trade responsibly. I traded too large sometimes and took too big losses. And this started impacting my ability to follow the rules. So once you kind of go through that experience, maybe you sort of have to go through it to where now I trade a more responsible level. I have so much more diversification. I have seen over the years that this strategy does have its ups and downs, but it has a tendency to not disappoint in the long run. I'm not jealous of other people's strategies. And so it just is a combination of, if you don't do things correctly, you should be panicky. You should not feel calm. And when you start doing things better and you get into this groove of following good rules, even my rules are super, my trading does not eliminate at all. It kind of has the most amount of volatility and potential profit give back. So I'm kind of trying to push the envelope of doing things that are very, very hard to do. And my analysis is that the harder it is to do, the better the strategy. So I am trading, the best strategy I know, and it definitely lets profits turn into losses. And big profits turn into little profits. And this is one of the elements that really people really just dislike. This is the one thing that every trader will tell you is the hardest part, which is hanging on to a winning trade as long as you should, as long as your strategy tells you you should, because we just get too afraid of losing those profits. We don't want to lose money, and we've convinced ourselves that that big open profit, all of that money belongs to us, and it's just going to be devastating if we wait and wait for that predetermined exit, because we may give back too much money. This fear is in our head, so we break the rules, or we create rules that are not good rules in order for us to make our conscience and our personality feel better. So I'm still pursuing maximum pain, maximum discomfort in my trading, but I've gotten used to it and it's worked well. My performance is pretty good relative to peers. So I trade small, I trade with lots of diversification. No trade is very important. So it's a combination of all these things. Having seen nothing better, I could go on, but it really is probably just something that takes a bit of time and some trial and error.
Wow. Yeah, those are wise words. It's letting the winners run and cutting the losers. And that just seems to go against human nature. We feel we got to take that profit when we see that green. And they have these myths, let's debunk some myths. They say you never go broke taking a profit, or exits are more important than entries. And they say all these kind of things, and take your profit. Oh, at least you were green, at least you made money. And it's a different way. The trend following is contrary to what we have been taught, it seems, in conventional thinking. And so just tell us about some of your rules. Please share with us. Besides trading small and diversification across asset classes and following your rules, could you share with us some of your other rules?
Well, I think all the CTAs and a lot of hedge funds, they will put on the trades. They'll determine the quantity of and the size of each trade based upon the recent volatility. So if the market's very volatile, we'll put on a smaller position than if the market's been recently low volatility. If that's the case, then the position would be a bit larger. So you're sort of sizing these trades based upon the recent volatility in the market. So you want to kind of look at each one of these trades as sort of a bet, and you want to equalize these bets to some degree. So you got all your currencies, commodities, bonds, interest rate markets, and stocks. So you've got longs and shorts, but you want all of these, at least initially, to put these trades on to where they all have about the same opportunity to contribute to the portfolio. So that's a critical part of trading. The nuts and bolts of trading is the proper sizing. Nothing's more important than your total risk budget. So when you figure out how much you're going to risk on each trade, then you have to add all of those up and say, okay, that's my risk budget. And so you need to make that, that's the one part of trading that you want to have your personality speak to. Your personality is not going to do you any favors on the creation of the system, because it's not going to like it, right? What's good, what makes you feel good is not what you want to do in trading. However, so you can follow your system, sleep at night. It's okay to be a trader who trades really large, because you can handle it. You can handle the drawdowns. If you want to trade a lot smaller, be more conservative, I think that's something you need to listen to yourself about. But that's, in my opinion, sort of where it ends. You need to pursue, you don't want to pursue ease, comfort, and pleasure, because what works in the markets are things that are not fun. I like to use the breakout systems. They're kind of crude measures of trend. I think crude measurements and crude ways of rules that are not very precise kind of work better in the markets. We have these spreadsheets or computers, and we want to get everything out to the fourth or fifth decimal place. That's just not the way to do it. So I like the breakouts. So if it makes a new high or a new low, you're going to start doing some long trades or short trades or exits in your systems. The breakouts are also good because, unlike a moving average, they don't move up very quickly. They're kind of a stair step. With the moving average, if the market is higher today, you're kind of locking in some profit, and that makes us feel really good. So that's got to be wrong, right? You don't you don't want to lock in this profit. You could have a couple up days, in a long trade, but the breakout may not even move at all. So I think that's why breakouts are better. They test out better because, once again, they're not that much fun. We always want to lock in these profits. So you got the entry, the exit, the stop loss is a multiple of your ATR, the risk in the market. And I'm famous for, I don't know if I coined the term, one entry, one exit, and a stop loss. And so I think that's very important to look at it this way. Now, I have 4 or 5 or 6 different approaches, systems. They're all breakout. They're all one entry, one exit, and a stop loss. But they just have different look back periods, 100-day look back, 200-day, 150-day, something like that. So you want to trade multiple breakouts, entry, exit systems. Yes,
Jerry, could you tell us about breakouts? How do you identify a higher probability trade breakout? And what parameters do you use? Any signals or anything? Please tell us about that.
Yes, I like the breakouts the most. They test out really well. It's really just a question to determine. It's going to be determined by the back test. What looks good. What I like to think about. I want to stay in these long-term trends. Sometimes these trends will last 1 year, 2 years, or even longer. And so the trader's job, in my opinion, is to do a lot of research on what works in the markets and what's worked over all the data, not just recent data or data a long time ago, but over all the data. And what we found in the late 90s was that some of the shorter term ideas weren't working very well, but that the longer term look backs, parameters that would keep you in the trade for an average of a year or so, they looked really good and they performed well throughout the whole data set. So it's really just a question of doing the research, doing the back testing. And of course, if you're trying to maximize your profit on these in each individual trade, we would take great care to do just that, to maximize the profit on each trade. We would say that's what we want to do. We want to handle these trades, and some of them are going to be these outlier trades. They're going to make all this profit. We wanted to handle them specifically, perfectly. And so then we would just add up all of our trades, having really took great care with them, and then this would be our performance. And that has worked so well for us. And so the problem, though, is to handle them perfectly, you have to have what we call loose pants. You can't be too precise. You have to have a long-term look back. You have to let the markets have some volatility and some sell-offs. And because usually if they have a sell-off that's really painful, it goes back to the highs again. So we're off and running again. And if that wasn't the case, the computer would say, then don't trade so long-term. But people look at these long-term systems. They perform really well. They don't get you out too quickly. They participate. They don't whipsaw you. And then at the very end of the trend, they don't give back too much profit. They give back more than you want, but overall, and that's the key, isn't it? It's overall. Because you can look back and see some trades that, man, that was horrible. You really did a poor job on those trades. And that's going to be true with any system, but it's not that particular year, that particular month, that particular trade. It's overall. It's over all those markets. How did we do? And that was our litmus test. How did we do? And you really have to go through some pain and suffering and ignore, like clients really don't like these losing months. They don't really like to look at these trades where you give most of it back. Can you come up with a way to preserve some of these profits? And we're like, no, we're committed to one entry, one exit, and a stop loss. We're not going to have these overlays that essentially are just discretionary. They're rules, and you can build them into your system with computers and stuff, but it's no more than just a discretionary thing. Like, I don't want to use money, come up with a rule. Well, that's no good. And so if you have this one entry, one exit, one stop loss type system, they make very good money. They have really nice drawdowns. They probably going to they're probably going to stay fresh longer because they're so hard to do. And then your sample size, your robustness, all the statistics that you really care about that are going to indicate to you, hey, this really is something you can depend on in the future, are going to be as high as it can possibly be, because you just don't have a lot of moving parts and a lot of bells and whistles. Someone asked me the other day about, well, something about bells and whistles. And I was like, oh gosh, Rich would be so disappointed, if I said something about bells and whistles. The mere term bells and whistles, you should just start running, because you don't want anything that's a bell or a whistle. It's these type of systems that we trade, they're very painful. The only thing that bells and whistles can do is to create less pain. By definition, they're no good. Do we want to take money out of the markets? Is that our primary goal? Is that what we're here to do? Or are we here to take some money out of the markets and feel good about it? And I often do, you've already mentioned a couple times, one of my favorite ways of doing of showing people examples of things, and that is, how are you going to raise your children? Are you going to tell them, follow these rules? This is how our family is going to do things. This is how we treat people. This is how we're going to handle the right way to live life. And it's just going to be smooth sailing. No, you're not going to say that. And they're going to come back and say, this is really hard. No one's doing it like we do it. Everyone else takes shortcuts. And you're going to say, exactly. But we're undeterred, full speed ahead, doing the right thing. And this is how life is. But in the end, you're going to say, wow, I lived a good life, or I tried my best. And I'm so happy that I was held to a much higher standard. What do you think?
I love that. That's beautiful. And those are great things to teach our children as well. There's no such thing as anything perfect in life. Everything's bumpy. It's not like a straight linear path. And so we teach our kids the same way. You learn from your setbacks, your mistakes, and that's what makes you stronger. And life lessons at a young age is what I always say. Our kids played chess very competitively at a young age, and they were homeschooled. And so they learned losses. You could be prepared, you could be ready, you could have studied for weeks, but you still take losses. And that just happens. That's just life. And I love how you say there's no such thing as perfect or totally precise to the 10th or the 100th. And, it's about quality over quantity. You take care of that trade and you maximize that by letting these winners run. Hey there. I love it. It's so cute. And your birds are beautiful. And you keep it simple. And that's what I hear from you as you're speaking. Classic trend following model without too many moving parts. You have one entry, one exit, one stop loss, and you eliminate the noise. We already live with so much information, information overload, I call it. And there's just too much noise. At some point, everything becomes noise. So it's important to keep it simple. And so I want to ask you, this whole conventional thinking about cost average down, buy and hold, I think we're going to debunk that myth. What are your thoughts on this cost average down?
Well, I think that I'm just too nervous and conservative to rely upon things like that. I just, number one is, I think in order to be successful with whatever strategy you choose, you need to be all in. You need to be all in, and you need to follow these rules. And so, as we've already seen, if it takes a 50, 60, 70% drawdown in my stock portfolio to achieve an 8% average return, then I can't do that. And I don't think that's good for me and my personality when I can wrap trend following around these markets, around the stocks as well, and make 7%, maybe a little bit less, but with a 20% drawdown or something like that. So if trend following wasn't available to me, then maybe sure. But not only, another beautiful thing about a systematic approach like this is all of the markets can go in the portfolio. You don't have to say, well, gold is good, buy and hold, and real estate's good, buy and hold. And at some point, I think recently they said Bitcoin was good, buy and hold. Mm-hmm. But we put every market in there, all the currencies, all the commodities, all the bond markets, and long and short, and stocks, and we can create this amazingly diverse portfolio. But the trend following turns all of those markets, virtually all of them, into profit generators. There's no opportunity cost by adding in commodities or currencies to a stock portfolio. They're going to make about the same amount of money over time. So it really is just this beautiful approach where at the same time we are protecting capital. I mean, that's our highest goal. We've got to stay in the game and protect capital. You can't even be a part of investing if you don't have a good strategy for protecting people's capital, including mine. I mean, I like my capital more than anybody's. And so I mean, if the rest of y'all didn't care about protecting it, I'm going to be protecting yours because I'm protecting mine if you're in my fund. And so, and at the same time, though, I want to have a good upside. And nothing we do deters in the protecting the capital part doesn't deter us from having the maximum amount of possibility of making money on the upside, because that's how trend following works. And so it's just a great alternative, and it's an easy alternative to are you going to buy and hold stocks versus are you going to trend follow stocks and trend follow all these other markets as well.
It's a brilliant strategy. And I think for me, buy and hold would be beachfront property, beachfront real estate because of its scarcity. That's something I probably would buy and hold, but everything else is questionable. And when you have a system such as trend following, there's no reason to be holding long term through all these drawdowns. And so excellent points there. Now, I want to go into your stop losses. You said one entry, one exit, one stop loss. You said it's a multiple of the ATR. Could you explain that a little bit for our audience?
Well, the typical way that CTAs and hedge funds would do it would be to look at recent performance, and recent volatility in a market is measured by ATR. Google ATR, listeners, and you'll figure out what that is. And so then maybe you'll risk like 4 ATRs per trade. Mm-hmm. So you give each trade the same amount of room before you get out, 4, 6, 8 ATR, something like that. So not too close. If the stop loss is too close, we're going to be whipsawed all the time. Not too far away, because we want the losses to be small. But it's this optimal placement that we can kind of get out of a position if it's not working. And we're giving each trade, once again, we're back to this consistently handling each trade the same way. It's almost as if each of these 300 different markets that we have in our portfolio, they're all the same. We want to treat them the same. So we're risking the same number of ATRs per trade in every market all the time. And we have the same entry rules, same exit rules. Everything's treated the same way. And this just allows you to keep those losses small and jettison positions that are not working for this time period, but you may put them on soon after you get out of it. But it's just a good way to keep risk at a manageable level. So yeah, that's an integral part of what we CTAs have a tendency to do, which is take those small losses.
Perfect. Thank you so much for that. Risk management is number one. It's always about protecting your capital. And we're going to talk about risk in a second, but I want us to talk about CTA. And, I read somewhere that you wrote, you start with the CTA and then you add some long only equities. Your firm seems to be a blend, a little different than the traditional CTA. And could you tell us about how you've evolved your CTA, which is more of a blend? And I love it. I think it's fascinating how you've created your thesis and your strategies.
I know. I just don't know why I'm so obsessed with, I'm obsessed with a lot of things, being successful, pushing the envelope, growing, getting better. I want trend following. One of my missions is to put trend following in a situation where it can fully perform better than it. Don't restrict it. And so I really want people to see it as wonderful as I do. And I really enjoy, honestly, I really, really enjoy. At the same time, though, That's my most important thing. But I really do enjoy that no one else really wants to do it the way I want to do it. And so that's fun. It's fun for me. And so it's an opportunity. You know, we have this ETF. It's different. No one has anything like this. And so simply coming out of Richard Dennis and I just believed what they said. I mean, I thought, what a blessing to have this opportunity. And when you get something like this and you get the money to manage, the track record and all this, you know, success due to them, and fun. It's the funnest job ever. It's not even a job, you know. So you don't want to blow this opportunity. You don't want to look back and say, well, you know, I could have done so much better. No, that was what I was afraid of. And so I was bent on following it and believing it. And one of the things that they said was, you know, very, very important, diversification. So I was like, yes, diversification. I wanted to always add markets. And as the markets kind of over the years, you know, there was more commodity markets, certainly more bond markets, and more currency markets. And then I thought, well, I'm reaching a limit here, but there are thousands of stocks. And CTAs traditionally didn't want to trade stocks. They wanted to trade stock indices. And I thought, well, that's silly. The only way for me to massively expand my portfolio is to trade these single stocks. And so that's what we've done. Half of our portfolio is stocks. There's a lot of diversification there. We made it half because it deserved to be half. If there were 1,000 commodity markets, then commodities would be half, or currencies would be half, but there's not. There's 5,000 whatever stocks, and so we trade about 150 of the 300 markets in equities, long and short, and we have a very diverse group of stocks. We spend a lot of time cultivating that group, coming up with the stocks that we think are going to give us nice uptrends and downtrends and outlier trades. And so this is the simple application of trend following to single stocks as part of this portfolio of stocks, bonds, currencies, and commodities. It's radical. It's revolutionary. Nobody in the CTA industry wants to do it with the trend following. And we're like, why? This just makes perfect sense. So we don't like buy and hold. We don't really believe in buy and hold. Some people will do like buy and hold equities plus the managed futures piece, so the trend following piece. But we said, okay, you guys do that. We're going to trend follow everything. So it's trend following plus nothing, trend following alone, but it's also trend following everything. And here you got this one sector that everyone loves. They think it's the best sector ever. It's the stocks. Everyone loves stocks. It's the only game in town. You try to sell them on commodities and currencies. They're like, I don't know. I'll give you like $1,000 in 2 weeks. You got to do something. And you're like, no, this is a great thing. With trend following, the commodities and the currencies, they'll do just as well as stocks, but you'll have a lot more diversification. But here you have this one group of stocks that everyone loves, but no one is saying, hey, let's trend follow those stocks. You know, everyone wants to say CTAs are for crisis alpha. Allocate a small amount of your portfolio to CTAs and trend following. So if the stock market crashes, you'll have diversified something else in your portfolio doing well. And I'm like, if you really want to put a limit to some of these crises, let's trend follow the equities. Every market needs a entry, exit, a trailing stop, an entry, a trailing stop, and a stop loss. If you don't have that, I don't care what market it is, you're going to be very disappointed sometimes, because even stocks, especially stocks, are going to crash. And there you sit, and you're told, buy and hold, do nothing. And it's so hard for people to do that they essentially kind of give up, probably at the exact wrong time.
Excellent points there. You said the important part, and I gotta say, your tweets are amazing. I love it. They must come from somewhere deep or divinely inspired, because they're really great. And I urge everyone to check out your tweets on Twitter, and we're going to share your contact info later on. You said in a tweet yesterday, I believe, about being the only, and how someone turned down $1 million. It was something in Hollywood, or I don't know, somewhere, but it was about being the only. And what you just told me, Jerry, you are the only. You're the one that is like a CTA, yet you're so much more diversified. And I love how you have evolved the CTA with individual names And you're diversified across all asset classes with trend following at the core. And I'm going to name them. I love talking about asset classes. Equities, that they believe with your new ETF is about 50%. Then you have currency, commodities, and fixed income making up the other 50%. And I love when we're going to talk about correlation and low to negative to positive, flat, zero, and all that. But it's an important balance, and I want to make that distinction for everyone that it's really a challenging thing that you've accomplished, Jerry, and I admire it because it's about being able to make your money when the market runs up. But it's also about being able to handle those drawdowns and having a balance at the end of having positive returns. And it's very difficult to balance that. So I give you much credit, and I love your very unique, creative way of doing this. So I want to talk about signals. What type of signals do you use? And also I want you to add your average holding period. I know it's changed since the 80s to 90s, and we'll talk about the differences. And what type of signals? More of a longer term price trend and economic signals rather than the short term, because the market is very choppy. What do you use? A blend of all that? And how do you incorporate that with the volatility?
I use, like I said, the channel breakouts, the trend that identify trends, and that's pretty much it. Try not to be
Simple.
too fancy. As a trend follower, you can't miss a big trade because sometimes the trade may not look that great, but it could be the one that's going to turn into a big one. So I have a tendency to err on the side of, it's better to take a couple extra losses to make sure you get in that trade versus trying to fine tune it too much and you miss the trade. So it really just needs to be a more simple mechanical way of consistently applied. Once again, even if it's not that sophisticated, if you apply it consistently, you're going to have some good results. So I think just whatever gets you in the trade in the right time frame. And our look back, our average holding period is about a year, because that's what the back test says is better to hold on to these trades for like a year or so. Now, we don't target, we want to hold into it for a year. We do the back test, it tells us, okay, these are the better parameters. And it says, and if you use these parameters, it's going to be a holding period for about a year or so. So that holding period and those parameters have gotten longer over the years, but I think kind of stabilized. And it's a really difficult way to trade. I think trading shorter term with shorter term trend signals would be more fun and easier on your heart rate, but it's just not what works the best these days.
Yes, especially with market choppiness. And, it's about keeping it simple and always being consistent. And that's so important. You talk about managed futures, you do a long short strategy with that. How do you incorporate this futures with your individual names and the long short? If you could tell us your thinking with that.
Right. So the first thing we do is we choose the markets that are in the portfolio strictly based upon the correlation, the diversification they can add to the portfolio. So we don't do a back test to try to find the perfect markets historically. We kind of want to have a mix of the currencies, commodities, stocks, and bonds. And like I said, stocks is bigger because there's more of them. And then we're just sort of focused on, do we have a safe portfolio? Is this giving us the most diversification we can possibly get? And then we take those signals. And so if the market is in an uptrend, we can be long. If the market's in a downtrend, we can be short. Nowadays, it's really easy to have longs and shorts on in the stock market, totally determined by, is it in the portfolio with a methodology that's not over optimized? Yes, it's in there. So some of the stocks we have, because they're so diversified, not everything's going up. Some of them are in downtrends, so we're short a lot, all based upon the trend signals. Nowadays with the bond markets, they're sort of pretty much all of them are now short still. So rates are
Mm-hmm.
higher. Inflation looks like it might be coming back. No diversification in that sector to speak of, really, because everything is in a downtrend. Foreign exchange is a little different. We had a big dollar rally over the past few years, and the dollar has
Mm-hmm.
been weak. And some of the currencies, euro, Swiss, Mexican peso, Brazil real, they're in uptrends versus the dollar. Some of the currencies and the British pound, let's say, and some of the currencies are in downtrends. The yen, China
Mm-hmm.
is a big one in a downtrend. So now we're afforded a little. We have on all of these trades. They're different. They all have the same positive expectation, and so we really are happy as a risk manager to have a sector like the currencies that we have some longs and shorts. And so there's no, we're not taking inferior trades. We're not forcing this diversification. We're passive, waiting for the trends to emerge and these signals that apply to each individual market to tell us this market's in an uptrend, the other market's in a downtrend. Same with currencies. We even have some within some of the groups of the currencies, like the grain markets, we're pretty much long soybean products, and short the wheat. I think we're actually long a couple of wheat and short a couple of other wheats. There's so many wheats traded. We're like the world's biggest wheat trader. We trade them all. And likewise with some of the metals. Now we've just turned to where we're pretty much long all positions in energy, crude, heating oil,
Mm-hmm.
unleaded. They're all pretty much long. Some of the bigger movers this year in the commodities have been sugar, cocoa, orange juice. Another great thing about CTAs is all these weird markets, these exotic alternative markets that no one trades except we do, except
Mm-hmm.
us. And what happens is all of a sudden, it's the reason your portfolio does well. It's the reason it does incredibly well, because you traded some of these markets that no one even pays attention to. And that's why after 40 years, I'm so in love with them, because they have really, over the years, bailed me out of situations where the traditional markets didn't do very well. But there's been times where OJ kind of made my year, or heating oil and coffee. Coffee, big, had some big moves in coffee before. So that's rare, to have a money manager that looks at all of these different opportunities and all these different sectors equally, and doesn't discriminate or have a bias towards stocks or bonds.
I love that. And that's what I admire so much about your strategies. I mean, I was studying and reading about you, Jerry. It's just amazing how you go into these less crowded trades, which I think is so smart. It's you eliminate that noise and a lot of that. They even talk about with futures trading how you don't have that same noise as with just regular day, trading options. And so to me, it's a clearer way of trading. And I think that's so smart. I mean, people want sugar, chocolate, coffee. We know that those are important commodities for people. So it's great. It's so brilliant that you go and you trade those and you maximize your potential over there, your probabilities. We always think in probabilities and bets. So like Annie Duke says, be thinking in bets. But it's very true. And so thank you so much for sharing that. You made another brilliant tweet, and I have to say, I love your tweets. I'm going to say again, the risk-adjusted returns. We're always conditioned to talk about risk-adjusted returns. For the regular trader, they always talk about how much they make. Then you take it another step further, risk-adjusted returns. And now you take that to the next level, Jerry, and you say the three most deceptive, disingenuous words in all of investing. And you say it's really about maximizing wealth over time. Tell us about these disingenuous words.
Oh my, that's like one of the greatest questions ever. You really
Thank you
set
so
me up.
much. I love
And,
it.
I'm pretending that I'm embarrassed by this, but I'm really not. I'm hiding my face, I'm laughing. Doesn't everybody know I was kind of joking? But honestly, I can't really say that it's not my quote. I quoted it from that article that I posted as well. But okay, it's really, I think, to some degree specific to trend following, or I only know trend following, so I can only comment on it. And I think it is definitely perfect statement as it relates to trend following. And that is, I tricked you earlier because I said it's all about protecting capital. I mean, that's Turtle 101, Turtle's 1983, protect that capital. So you can just imagine how many hours we heard that and how often we heard that. Nothing's more important. I know one time Rich asked us a question and he said, here's the question. I want a one sentence answer. And I did not understand the question, but the two choices were protect capital and something else. And so I knew the answer was protect capital. I just didn't even understand the question. So, okay, so what is capital? Capital to me is the money that you give me. And I'm even going to throw in there the profits and losses that the money that I've made so far. What capital isn't is all of the open trade profits that I'm allowing to run. So we have these trades that are open, make massive profits right now in OJ, sugar, and cocoa. And so that's not capital. That is potential something. It's going to be some trade that we're going to get out of soon, and we're going to know how much we made. So in order for me to let those run and follow the system and choose a system that's going to make the most amount of money for us, the computer says, let those profits run. So if you force me to protect those open profits, then I'm going to get out too quickly, right? That's how we started this whole conversation. You don't get out of your profits too quickly. Well, then you can't hold me to that and judge me from, it was at this level, now it's sold off. Well, our system says stay in it. We're not ready to get out yet. But look how much money we've given back. I know. But if we apply this rule for all of the trades, for all time, we'll make more money. So the problem with sharp and risk-adjusted returns is they're going to penalize people who let profits run. You see? And so you have a tendency to, well, we're in this world where people don't understand what we do. We want to raise money. We kind of believe it ourselves that volatility equals risk. So let's have another rule that gets out of these trades quicker if the volatility picks up. And I'm like, no. There are too many rules, too many parameters. You're just playing a game with sharp. It has nothing to do with reality or protecting capital. It's certainly not letting profits run, which computer loves. It loves to create pain for you and then say to you, yeah, you're going to get all this pain of volatility and giving back some of your open profit, but you're going to make more money. And I'm like, sign me up. I'll take that. Most people don't want to take it. They want to take the trend following, massage it with rules that allow you to get out of the profits quicker than you should, to smooth things out more, which is going to be rewarded by sharp and this term risk adjusted. So that's a long-winded way and kind of a complex way of saying, I am protecting capital. Classic trend following protects capital, but we redefined it as the money that you put into the fund and all the realized profits and losses. Now, can we please treat the winning trades different, maximize their profit? We care about them so much. To handle them perfectly in the optimal way that they should be handled. And the way that they should be handled is loose pants, loose parameters, give them an opportunity to even go further than they've already gone. It was not the case historically. We would not be doing it. And let's close our eyes a bit to open trade volatility. It's not really risk. Our risk was that stop loss in taking that small loss, which these trades are not subject to that. They're not going to have a small loss. They're going to just be a big, huge profit. It just depends upon how big that profit's going to be. And are you going to listen and pay attention to your back test, your strategy, and follow those rules? Or are you going to be compelled to do things suboptimally because some people look at sharp, some people think volatility is risk. You're going to be pressured by other people, people who allocate money, traditional Wall Street or quant types. This is just a given. that you have to pay attention to sharp and risk adjusted. So another great thing about our strategy is we're one of the few traders who handle things this way, who truly let profits run in a way that's best for clients and best for me. Yeah, because I'm in the funds as well. And so why do I do this? And I've just never, I guess I've fed off of people disagreeing with me that we should submit and give up on classic trend following and have this sort of volatility overlay. And I've really been happy all these years having less money to manage but doing it the right way as far as I'm concerned.
I love that. Thank you so much. That was excellent insight. It's always about doing it the right way and doing what feels right. I love that. And who
Yes.
cares what they say? Be
They
the
think
only.
they probably think, in their defense, they're saying, well, we think another way is the right way.
Yeah.
And I'm like, okay, cool. But I'm one out of, I'm 1%. I am like, everyone disagrees with me on this subject. But whenever I go through all this and lay it all out like I just did now, I don't really get much pushback. If you go to people, clients, even smart people, even institutions, and say, I'll give you the trend following with the smoother returns, without any downside, there's no cost to this at all, everyone's going to take it. But the cost is you just make less money.
It's about maximizing those returns. And
Exactly.
I just love that you follow your heart, you follow your back test, you follow what works for you, what you believe in, and you don't let anyone else deter you. And that's true success. And it's, I always say success is subjective and it's not necessarily quantifiable because success varies per, everyone has their own version of success. But to me, that's true success, is following what works for you and not letting other people tell you otherwise. Jerry, you're truly the only, and I love that. You're the 1%. And, and it is quantifiable. You've had mass success, and congrats to you. Amazing. I want to ask you about how you decipher volatility from fundamentals changing and something changing. Now you said while it pulls back and it looks like you're giving up some profits, but how do you distinguish that from volatility from something drastic really changing?
Well, that's a tough one, because I think when you start out as trend following and systems and rules and following prices, essentially, you kind of it's better just to go ahead and turn your back totally on fundamentals and choose one over the other. I don't think it's going to be better to try to incorporate both. And basically what trend following, I think to some degree, I've heard this a lot. Now, I don't have a problem with it. I think it's kind of probably true, which is that there's so many fundamentals. They're almost impossible to decipher and know them all. The world is too large. And then a lot of these fundamentals, or most of them, or the most important ones, are sort of embedded in price. And so if you're just following the price, sure, you're going to be late getting in, late getting out, but it's the best and most objective way to ride these trends and at the same time make money and preserve capital. So obviously some people are in the know as some of these markets sell off. I'm not in the know. I don't know the fundamentals of the commodities or the currencies or the companies. So I just wait for the trend to turn. And in fact, a little bit of a part of the turtle training has been lost because part of it was also to incorporate in kind of a discretionary way the systematic rules with a contrarian idea, a contrarian philosophy, which is to try to adjust the trading a little bit based upon what people were saying. And so if everybody was bullish, so maybe you would be hesitant to buy, or if people were really bullish on a trade that you were already in and you were making lots of money, you may want to liquidate a little bit quicker. So whatever the fundamentals or the news was saying, your idea was it's always better to do the opposite. And so, if you start buying the breakout in some market and everyone is talking bad about it and there's no support for this trade, you should be very happy. But if everybody likes the trade and too many people like it, especially after it's gone a ways, then you should be very nervous. And the lower the source, the better. So if you read it in the New York Times that everybody is bullish on sugar, it's an irritating thing, but maybe nothing to worry about. But if you get into a Uber and your Uber driver says, "Hey, I'm long sugar too," it's probably over.
Excellent
So
points.
yeah, so I don't really use that any longer. We're computerized, systematized, and it's just the fun part of turtle trading that kind of got lost over the years. But I'm sure the bottom line is, I'm sure it's better to fade the fundamentals, or at least not pay any attention to them and follow the trends.
Love that. Wise words. And yeah, it just goes back to Kennedy and the shoeshine boy, I believe. Remember that story? If the shoeshine boy is telling you stock tips, or telling you about a specific stock, that's not the one to be buying. So yeah, absolutely. Don't listen to the Uber driver. How
Nothing
do
against
you
Uber drivers.
yeah, I know, but they shouldn't be giving us stock advice or tips. So how do you handle trading 300 plus markets and different equities and commodities and all that stuff? How do you handle all that?
Well, it's great because we're not experts in any of them. We're just feeding our models, or our simple trend following models across these markets. And because we're doing that, we're able to trade that many. We need to trade that many. This strategy is going to be a lot better off the more markets it can trade, liquid markets, diversifying markets. Not too diversifying, though. It's okay to trade crude, heating oil, unleaded, gold, silver, and platinum. They're kind of similar, but you can get some different outlier trades every now and then. I've seen a few times, where heating oil like doubled in price due to freezes in the New York harbor, and crude just kind of sat there. Silver went up a lot in 1987. Gold kind of sat there. So it's a different market, it has a different name. You can expect sometimes to get a really different performance. People want to pay attention to these relationships, and they're written in stone. Whenever crude does this, bonds does that. Or crude and heating oil, they're very similar. No reason to trade both. But we're kind of like making money all the time from things that seldom happen, have never happened, very unusual. Relationships are broken. They no longer work anymore. People are skeptical, and we're just blindly following those trends. So, but practically speaking, to answer your question, you have to have a computer, you have to have a systematic approach, and and it's helpful for us because we trade so long term that we're not doing a lot of trades frequently. So we're holding on to these positions, cultivating them, trying to be patient, allowing them possibly to turn into a big outlier trade. So we can kind of handle 300 markets. It's not really, really easy. I'd rather trade 20 by myself, just staring at my computer like I did in 1984. But it's so much better for everyone. And for me, it's more fun. Can you imagine sitting at your desk and being aware of what's going on in Europe? Some of these commodities, we trade South Africa, Brazil, Malaysia, Singapore, Europe, Canada, all over. So it's really fun to have a portfolio, to knowing that you're watching, you're aware of what's going on, not just in the U.S., but all over, in all these different markets, just not the stocks.
It's exciting. You're so lucky you get to watch that, and how all these moving parts come together. Fascinating. Currencies, interest rates, and all global macro. I mean, I think it sounds like a lot of fun to me. So that's so cool. So I want to ask you, well, I know you talked about trading more markets tend to give you smoother returns. As long as you don't lose the robustness, you prefer that. And so who cares about this Sharpie ratio? We'll just throw it aside for now. And so trading individual names, this is how you're unique from other CTAs that don't do that. Now, I read that you said that by trading individual names, it adds even more diversification. Tell us about that.
Oh, for sure. CTAs in general trade futures. I'm trying to break out of futures. I don't want to be managed futures. I don't want to be futures. Trend following needs to be unshackled, unbound. It goes everywhere. It's the best thing. It's the prettiest person all the time, everywhere. It should not be left out. It should absolutely be applied to stocks, not just stock index futures or futures markets. I love futures markets. That's how you access efficiently and the best way to
Efficiently.
access currencies and commodities and even bond markets. We trade a few ETFs, but mostly bond futures. So I love futures, but look, stocks are different, but it's irrelevant that they're not futures. They are a great market that absolutely trends. And you get lots more diversification by not trading the S&P 500, but breaking open the 500 and trading each of those individually, or some of them, whatever you can handle, and creating your own portfolio of more diversification, a few from each sector, let's say, and then sizing them each individually based upon their own volatility, and then allowing these some of these stocks to really have some that are going to have some big moves to fully participate in those big moves. Some of the when you look at the S&P stocks, some of those stocks I would want to be long. Some are in uptrends, some are in downtrends. I want to be short some of them, and some of them I'd be flat. They're really not doing anything. So, but you're either long the index or short the index. So it's really kind of a screwed up way of handling stocks. And even trend following that, I don't think it's a good idea or very legitimate to trend follow a basket of 500 stocks. Much better for every reason to open up the situation where you can capture outliers by trading those individual markets. And if you look at them now, like probably all the indices, the 20, 30 indices that CTAs trade, they're all pretty much long. So I have, like I said, a lot of longs and a lot of shorts in my single names. And so that's automatically giving me more diversification. You can't really say you have the type of diversification as a risk manager that you really want to have if you're long everything, or if you're long everything in the category, in the sector. So in stocks in particular, you want to have longs and shorts. And I don't even have to force it. I'm just following the trends of a diversified group of markets.
Love that. I wish we could do a turtle trading experiment, take two. You have so much wisdom that you could share with all of us. I love hearing you talk. You've internalized that turtle system, and you've created the Jerry Parker turtle and trend following plus nothing. I love this. This is awesome. I want to ask you about risk parity and how you balance the allocation with respect to volatility and the expected value across all these markets. It's so important to balance that expected value. How do you do that?
Well, like I said earlier, I said each trade, handle each market individually, specifically applying these rules to each market. And part of the rule is, setting up these markets to have the same kind of risk and potential for profit in the future by sizing them with the same formula based upon the recent volatility in each individual market. So but then I'm kind of done with it. So if it turns into a loss, then I'm going to get out. But if it keeps going and it turns into a big trend, then I'm not going to touch that trade. I'm going to let that profit run. It's going to get more volatile. It's going to overwhelm and become maybe 2 or 3 or 4 times the position it was. If I'm lucky, I put the trade on, a good trade on with a low volatility. And as it starts to go, the volatility increases and it becomes more and more profitable. And yet it's becoming, in some respects, more dominant in the portfolio's returns. So I've tried to ignore that and just look at it in terms of, well, if it was a loss, I would have taken normalized the loss, the dollar loss. But if it's a profit, I'm going to let it run. And this is back to the part that scares people. It's scary to let profits run So people don't like to do it. We want to have a justification. Not only does this volatility overlay and correlation management and volatility management, not only does it smooth out performance and reduce the volatility of markets that have grown and become very profitable, but it also helps us to take profits prematurely. So that's something I don't want to do, and I want to use these risk tools in a manner that's really specific to protecting capital, with no ulterior motives towards winking at the really problem of letting profits run. Somebody's got to stand up and be the tough guy in the room. Although it doesn't help you if you're the tough guy and you give back too much profit. And you will give back too much profit on some of the trades. That's the one thing that trend following is no good at. How should I handle this trade? And I'll say, I have no idea. This trade? Yes, because this trade, this month, this period really means a lot to me. And this is our brain is telling us, it's tricking us into saying, what's more important than right now? And I can tell you for humans, nothing. Right now is very important. So if you could only assure me and do something to minimize the problems that you may have of losing money or giving back too much profit on this particular trade, I really would appreciate it. But trend following says, no, I cannot do that. I'm all about what's going to work over the lifetime, over all of the trades, over what's going to make you the most amount of money when you retire, when you hang it up. That's what I'll tell you. This is what it's going to be. But you're going to be really disappointed on some of these trades. You're going to look stupid. You're going to be the worst performer relative wise. But if you want that glory at the end, this is what you have to pay to understand that it's not always going to work out well for you over shorter time periods.
Wow. Love that. You focus on the big picture, and they say all's well that ends well. And I guess with trend following, we end positive and with the maximum growth. And I think that's a great way of looking at it. I know it's challenging in the midterm. I want to talk about how it's changed over the years. From the 80s when you began, I read how it's become choppier. So you've gone longer term, and now you're about a year. What are you doing? What about this environment?
That's right.
Yeah. And what are you doing in this environment? Now, you've had longevity in this market I remember 1987. It was in October of 1987. You've seen all of this. So with your experience in being a trader and being alive and experiencing all this, how are you viewing this macroeconomic environment that we're in? We went from free money, negative rates, basically, post GFC until just recently. Now we went up over 500 basis points over the course of like a little over a year, and it's higher for longer. We had core inflation. The July report just came out today, 4.7%, up 0.2% month over month, and broad-based CPI also up 0.2%. I think it was came in at 3.2%, something like 3.1, something like that. And and we have massive debt, 32 trillion domestic. Now we got downgraded. Our interest is 1 trillion. I mean, I could go on. Corporate profitability is challenged, margins compressed. With all that in mind, how are you taking that, and how is it incorporated into your strategies? And what type of time period are we in for? What are you thinking for the economy and trading now and going forward?
Well, it's not incorporated into my strategy at all. So hopefully the trends will, and my strategy of following those trends will help me avoid problems, get me going in the right direction, which inevitably I will be. Obviously, hopefully it won't be too slow changing directions or sticking with the current direction, the correct direction as it kind of plays out over time. But you made me think about the bonds last year and sort of inflation, and at some point in time with rates at zero, close to zero, we had to expect, rates were going to go higher. They're not going to go much lower. So at some point in time, we had to anticipate this. And I just remember watching the system start to go short and not even thinking it like that. Like, okay, here's the big trade we've been waiting for. And like, I didn't even think about it. I mean, I was just so out of it. Like, I'm so engrossed. Okay, what are we doing? What's happening with the trends now? What are the systems doing? Well, they're getting short. Like, okay, cool. And I think when you just get so wedded to this strategy, and it's like a game that you're playing with these numbers, you don't even think about, well, something real life is happening here, and maybe you should double up your position. You're like, this is what we've been waiting for. Let's double it up, because the fundamentals are probably saying we can probably see what's going to happen, and let's violate our rules a little bit and get more aggressive. So I think that's what sort of discretionary hedge funds do. You have a lot of smart people. They probably try to take small losses. They probably try to time things a bit with trend. But we're like, look, we know nothing about anything, nothing, or we do know something. We do have opinions. We went to business school. We're just not using it. Which you're like, that's stupid. And we're like, I know, but it just has a tendency to be more reliable. Because sometimes when you know it's an obvious trade and you try to double up, it's not an obvious trade. You're wrong. You're going to take a loss. And so that's what we think. And that's what we know. And we've had so much success with this strategy. After it happens and you see the inflation and the bonds sell off, I'm very articulate as to what I believe and what happened, and what might happen in the future. And I'm really thinking about it, and I'm reading the news, and talking to people and watching podcasts. So, but as it's happening, it's just like we have no opinion. We're just like letting the computer do its thing and enjoying these trends. So we see them as trends that we're following first and foremost, or at least I do. And the actual fundamentals of the world that everyone else cares about, we're like, oh yeah, I guess there is something actually going on that's real. That probably wasn't the case with COVID, because that was so overwhelming that we did get the trends right. We did start making money, but something like COVID was so devastating that it was hard not to think about the positions as it related to the virus at the same time. But we just get overwhelmed in our little world, and don't pay too much attention to anything else.
Wow. Yeah. Well, trend following at the core, and you follow your signals, you follow the price, and you follow your rules. And so you don't let anything else affect that. So let's take off your trading hat for a moment, and let's put on your, person hat, your economic hat. And let me know I'd like to know your thoughts on economics. What you think. You experienced these time periods, the 80s. That was a difficult time in the early 80s. We were just coming off that stagflationary period. What are you thinking, just personally, when you look at our economy? Just wondering your thoughts based on your experience. Do you think we're in for maybe a stagflationary environment, or is there a recession upcoming? What are your thinking? What's your thinking with that?
Well, I like to talk about three things that formulate my thinking about the economy. And one would be inflation. So I'm a child of the 70s. I was in high school. I believed Milton Friedman, monetary policy.
Love it.
And I thought, this informs me today. And that I get it that other people have different ways of looking at inflation. I think maybe I should say monetary inflation. Obviously, if you put a lot of money in the system and it's spread out to people, that's going to increase demand. They have more money. So money is the demand, and it's been increased because there's so much more of it in the system that it's going to put prices up. Now, the thing to realize is that some prices are going to go up a lot. Some prices may even go down. But inflation is this general rise in prices. So I just get a little frustrated, especially nowadays in 2023, of this denial that the primary problem we have with inflation is not due to the increase in the money supply, which is well documented around the COVID period, if you know what I mean. So that's frustrating to me. And I have read and listened to podcasts, and there's a token amount of acknowledgement of that, but then they get off into other, I'm not sure why. It just seems like that's got to be the fundamental driver. And that's my trend following brain kicking in. I just can't get over it. I can't get over the fact that I know that's going to be true. There could be other
Agree.
factors that make some prices go down and other prices go up a lot more. Okay, that's number one. Number two, I would say is that informs my opinion is taxes. I love this statement, Laffer statement that was, we know two things about taxes. If rates are zero, we're going to collect no money. If rates are 100%, we're going to collect no money. In between, we don't really know that much. So I think that that's where we should be looking. We should try to maximize the economy and maximize jobs and wealth and GDP by finding that perfect place on the tax curve, on the marginal tax rate that makes everything really go the best possible. I'm sympathetic to punishment, not a big fan of punishing rich people. I wish that wasn't in there. I'm a big fan of helping people who need help. There's all kinds of reasons to spend money and to have tax policy, but really, when you think about it, we're probably going to be really well off if we can find that rate. And it may be way too low for some people because capitalism is this wonderful thing that creates this great standard of living, and the tax rate is so important. And once again, in order to maximize the revenue from the government and maximize GDP and wealth, it's the most important thing going, because we're humans, fallen humans, who are looking out for our best interest all the time. And this marginal tax rate really means a lot to us as it relates to whether we're going to work and how hard we're going to work and our creativity. And I'd like to see people be rewarded for, for creating great things for me. Think of all the great things that you and I have because of other people. I'm very grateful for that Bill Gates and Elon Musk are billionaires. I love that. I'm so happy that they are, and lots of other people who've made my life so much easier and better and more fun. I love Starbucks. I'm glad the Starbucks guy, he's a billionaire too. I think that's fantastic. And then just in general, I remember going to a conference one time and we were chatting amongst a bunch of European CTAs and American CTAs about politics. And I made this statement: I can just tell you one thing, whichever country is practicing the most capitalism, that's the country that's going to be the best well off. They're going to have the best standard of living, and they're going to be more happy. Their citizenry is going to have more wealth. And I tell you, those Europeans disagree with me so much. These guys from the welfare state. And I just think that that's another thing too, is I was heavily influenced by Milton Friedman, Free to Choose. When I graduated from college, I read that book. It's like the greatest book ever. I even watched the PBS miniseries in like the 80s. Still out there on YouTube, I think. So these are the sort of I'm a fundamental macro kind of a, broad principles guy. Give me the principles that I can invest my life into, so I'm well equipped when the specifics change. When the markets change, I'll become a little longer term, or I'll add a few markets. I know how to make things better when I know how to handle situations if I have the core important principles in my heart. And so that's just the way I like to approach life. And I hope it does sound like I don't want to change and I'm not prepared for change, but I do think that if I'm going to err, I'm going to err on the side of trying to find these big principles that are true in life and true in the markets, in the economy, and hitch my wagon to them, knowing that maybe, as always, the specifics, the world changes and markets change, but I think sticking with some of these principles can do us pretty well.
I love it. You're a humanitarian as well. This is so beautifully what you said. I know we also live our lives principle centered, and that's key. And those are our value. Exactly. And that's how my husband and I are. And we raise our 3 kids the same way. And I know it's important to have your values and principles, and those remain with you. And I love that. Thank you so much. I also like Starbucks. Guilty confession. I love it too. And
Exactly.
Milton Friedman is the man. I love him. I'm a monetarist at heart, and I studied with Steve Hanke at Johns Hopkins. He was actually on the show, and he's a monetarist. And we talked about Milton Friedman at length. And I love inflation is always and everywhere a monetary phenomenon. And I really believe in that. And at the time, my son was 8 years old, and we homeschooled them. And I remember saying to him something about supply or something. And he said to me, and he knew this, it just was like common sense, I guess, for a child. He said, well, if you increase the supply of something, doesn't the value go down? And it's like, wow, that's exactly the core of this issue. They increased the money supply significantly. So you just knew that this value would come down and you have this inflation. I think it's just, to me, it just makes sense and it's clear cut. So I love that
I
you
would
mentioned that.
I would love to see the Fed replaced by a computer.
Right?
So these are radical thoughts, though. But just like a lot of things that that you think are true in life, they're rare. I was telling people recently on podcasts, here comes Jerry again, telling us to eat our broccoli. And I think I'm just a parent. I'm a grandparent now, so
Oh, no,
you're just
congrats.
always with bad news. Life is tough. You got to do the hard thing, do the right thing. This is how you want to succeed. You want the shortcuts in life. God knows I've tried the shortcuts. I keep trying them. I'm a human, but
Hmm.
the only thing that kind of works. And I admire people I have friends who are not that kind of mentality. They are not interested in shortcuts at all, and I'm jealous of them. But yeah, we definitely need to replace um, the current philosophy of how to handle the economy and manage the economy and massage the economy, because the downsides to zero interest rates and lots of spending and solving all the problems immediately and no recessions or attempting no recessions and soft landings, they have consequences. It's not just all one side. Sometimes it's right in its time to pay the price for your misdeeds and mistakes and learn from them.
Agree. Absolutely. Well said. Thank you so much. Now, I think, I was reading some research. It said the 60/40 portfolio had the worst drawdown in 2022, even worse than 2008 in recent history here. So I think there's no better time than to have risk mitigation strategies, multi-asset diversification across all asset classes, and trend following together with TFPN. And I want to talk about this. I want to break down this beautiful ETF that you created, trend following plus nothing. I want to just say, I love it. I went to your website. I urge everyone to check out the website for this great ETF that you created. And it's a creation. It's just like an artist creating artwork or a book. You've created something great, like a legacy. And it's just beautiful. I love it. And it's all weather, one-stop allocation for all market cycles, seeks capital appreciation by trend following futures and individual securities. And then, as we said before, 300 and plus markets, significant broad diversification right there, across 4 macro asset classes: currencies, commodities, fixed income, and our favorite that everyone loves, equities, because everyone loves stocks, And so it's next generation, and the key, liquid. We want liquidity, and we love that. So it's liquid, and that's so important because you have a lot of asset classes that are very illiquid. So liquidity is key. And these are strategies you've been using yourself since 1994. Amazing. So I guess I do know the meaning of the name, but tell us about this plus nothing meaning. What is that significance? I guess it just means it's just trend following. Tell us about that in the name.
Well, yeah, it's really just pushback on how CTAs have changed over the years and become less trend following and more managed futures, which managed futures now is really, adding things to your trend following system, like to smooth out the return. We're embarrassed by these returns. We're embarrassed by the choppiness and the drawdowns. It's the right thing to do. It's the best strategy out there. It is protecting capital, but you people don't like drawdowns from peak equity. We're embarrassed by this. We don't like it. In order to make you like us more and to give us money, we'll come up with these add-on features that basically, in a nutshell, don't let profits run, or they're negative skew additions like short-term trading, mean reversion, pattern recognition, the carry trade, short-term trading, little things that they add that don't add any value at all. In fact, some of them are negative skew, I think. But then they corrupt and contaminate the trend following with volatility management, correlation management, managing the equity curve, managing the open trades, because these open trades need to be managed. No, they don't. You just let them run and move your trailing stop up. No, 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 no. Too much volatility. People don't like it. They don't like singularly looking at a trade and you give back half the profits. But if when I do that, I'm following these rules that make more money than what you do. Oh, well, that's in the future. That's not today. Now I got an itch that needs scratching today. So this is my pushback that it's trend following, one entry, one exit, one stop loss, let profits run. And so I'm surprised. It's kind of a silly term. I'm surprised they let me get away with it. I am not, it's not as funny. It's funny to me. It's beautiful. It's perfect for me, but
I love it.
It is a little silly, but I think it's, but then once again, like I said earlier, it's trend following everything. So it's nothing but a trend following strategy, but we're seeking, with 300 markets today, maybe 500 in the future with China commodities or other markets that I'm not the most diversified manager, but there are some out there who have access to more exotic markets in China and other countries. But we're doing the best we can with what we have and achieving quite a bit of diversification with equities as well.
Thank you. I love the name. I think it's catchy. It caught me. I had to look at it twice. I was like, wait, plus nothing? I was like, what? And I thought it was it has that little spark to it. And there's just a lot of ETFs nowadays. And so to have that little spark, that little different touch to it, I think is really cool. So I really like the name. I thought it was very cool, very creative.
Thank
So
you.
you're welcome. The motivation for the ETF and the process. If you could tell us about this journey you went through and how it compared with the expectations you had, especially in this type of challenging environment that we're in.
Well, we've been running this program for a while now, long time, in a private fund and with just a few investors, and I was the biggest investor. So we thought that, this might be something fun to do and get our name out there. I think there's a lot of pent up demand for pure trend following equities. I have a big I have a nice Twitter following. There's a lot of loyal people who love trend following, like to talk about it, discuss it with me every Friday at 7 a.m. on Twitter. And so, but it's really a selfish thing that I did because I just sort of said, I don't have another 40 years and I don't really need another 40 to have fun. And my main thing is to create what I think is the perfect portfolio, the perfect strategy, what I want to do, honestly, without really regard. If it doesn't raise a lot of money, it's not going to change my life at all. So I'm a free man, with the ability to come up with what I think is a brand new idea. Well, it's not that brand new, but it's something no one else is really doing as far as CTAs, to offer it to retail people who love it. And they love this whole idea. They're much more accepting than, let's say, an institution and who is going to pay attention to risk-adjusted returns. I don't care what. There's not an argument I have on the planet that would make them think for a second that they shouldn't pay attention to Sharpe or risk-adjusted return. But the average girl and guy, they understand totally. They get it. They have no trouble. They're looking forward to something like this. And I spoiled myself by doing it just the way that I wanted it. Because look, it's not a real world to come up with something that you want without regard of, is the public going to buy it? Or do they want it? Is it what they need? And I think the vast majority of people will say, I would prefer what my friend Eric has or my friend Corey has, which is some long equity and bond exposure on one side, and then some CTA trend following on the other side. So I'm very happy with a combined portfolio of long S&P, long bonds, and the crazy trend following with the other half of the money. But I was like, nope, we're going to trend follow those stocks. We're not going to, and trend following is not always going to work on stocks as well as just buy and hold. It's not perfect. It's not always going to be better. Sometimes we have these V bottoms and the market crashes, and about the time the CTAs get out and get short, it goes right back to new highs. A big trend following failure. But I'm like, well, you know what? I don't care. I don't want to buy and hold anything. I want to put a trailing stop on it. I want to have a stop loss. And this is what I'm going to do to spoil myself without regard to maybe it would raise a lot more money doing it another way. But in my mind, that's just someone has to come out with something that truly is really unpalatable to most people. That is broccoli. That is hard to do, but it's the right thing to do, in my mind. And but not perfectly sellable, or people are not going to beat down the doors to buy this necessarily. They might, if properly educated, or they have bad experience in the stock market one of these days. And the one thing that people kept telling me on Twitter, my friends on Twitter, do not water it down. You've been talking about what you do, give it to us straight. Give us the 300 markets, let the profits run, let us experience these stupid, horrible drawdowns, because we believe like you do. So, the problem is it's like 1 in 20 or 30 people who believe this way. So, but you never know. Over time, maybe it will grow on people and they'll see the benefits of, what's that term I wanted to use? A less traveled path. Yeah.
Well, the less traveled path seems to be the exciting and the right one, in my opinion. I think diversification across asset classes is key, especially in this type of environment that we're in, which I think we're going to be in for some time. I think we had a little, short time period in time that we had easy money and you could just throw money into 60-40 or, all equities, and you made great returns. I think we're in a different time period, and I think we need alternatives more than ever. So you already had me sold it before we even started this podcast. But Jerry, you're selfless. You're not selfish. To me, you're selfless because you're able to have shared. You put time and effort and resources into creating this ETF, and you've shared it with all of us, and you made it easy to enter. All we have to do is go buy the ETF, TFPN. It's right there. And there you have not only trend following, but you have diversification across all asset classes and global macro, and that's key. It's not just different assets, it's diversification globally. And I love that, all the different currencies and all the different markets. So you've actually given people the opportunity. And to me, that's selfless. So thank you so much for that. And, and like I said, there's no better time. I think this is much needed. And so thank you. I want to talk about how your diversification reduces idiosyncratic risk by diversifying in a basket and different, sectors and within our equities, but it also provides systematic risk reduction because you're going across all asset classes or a large variety. Well, I don't like to say in extreme, so we won't say all, but we'll say large variety of asset classes. Now, let's talk about correlation and covariance and how you work with these correlations, that you're able to have your alternatives provide protective properties in these drawdowns, because we've had a lot last year.
Right. So we're trying to hit these drawdowns or, bad periods and bad experiences in markets 2 different ways. One is with, well, maybe 3 different ways. It's kind of like you've got the different markets, lots of different stocks and currencies and commodities and interest rates. You've got the shorts. Sometimes there's no place to go. There's no safe place except to be short. You can't find any good thing long that's happened. It was definitely COVID. And then we're going to wrap trend following around it, which naturally is going to get us into the best trades that are, sort through the trades. We're not going to own everything all the time. There's a time to be long and short and flat, and we're going to take those small losses. And at the same time that you can look at our fund and other funds, there's Florin Court with 500 markets. A lot of the other CTAs have access to, they don't choose the stocks like we do, but they trade hundreds of markets, and they just have access to over-the-counter type markets or stocks markets that are not traded on an exchange, but there's a lot of diversification out there. So this, you could say that, especially I'll say for me, you could accuse me of like, you care more about diversification than anyone. And I'd say, well, kind of, in the sense that I trade the 300 markets and I've done this analysis, and I'd say, okay, looking at all the data, it's these markets, these 300, they give us a good chance to have a good diversified portfolio, but I'm not obsessed with it. And sometimes I'm going to have on too many currencies or commodities all in the same direction. And I trade crude oil and heating oil. It's kind of the same thing. So why don't you just get rid of one of those, or trade them both smaller? And that's because my bottom line, even though it looks like correlation is what I'm really interested in, diversification and stuff is my bottom line. It's really not. It's really hunting these outliers and getting on board of these big, huge trends. And unfortunately, when you run your correlations and you look, you will make choices to eliminate some markets. You'll even come up with this conclusion: you don't need to trade all these markets. 60, 70 markets is fine. And then traditionally, the more markets you add, the less important each additional one is. True, but not if your bottom line is getting those big outliers, because sometimes only heating oil goes a long way. Crude sits there. During the 21 movement in the grain markets, yes, we were long wheat, corn, beans, bean oil, meal, canola, rapeseed, palm oil, but there was a couple of those that had outrageous moves, way bigger than soybeans and wheat and corn. So but yet they were all correlated. So you can have this directional correlation, a 90% correlation in markets over a period of time, and yet one of them may make way more than the others. And so that's really where our heart lies, which is this classic trend of taking these small losses, letting winners run. But what's going to pay for all of these losses and make all the money is maybe 10% of the trades that are going to have these outrageous size profits. And that's why it's so critical to handle those correctly and not be emotional and try to get out too quickly and take a smaller profit than you're due. Because with the strategy that has a really unfortunate characteristic of 60% of the trades being losers, which you're handling perfect because you're limiting the size of the loss, but it just makes the need to handle the winners so much more critical. Because if you don't handle those winners the correct way by following the system to a T, then you're not going to pay for those winners and make the fair return that you should make.
Exactly. Well said. Hunting outliers. I love that. That's a great term. Maybe I'll give it.
My friend Richard gave me that term.
I'm going to name this podcast that. I'm going to have
Okay.
that. I'm going to call it Jerry Parker on hunting outliers or something
That's
like
right.
that. Because that's the key here. This is the beauty of this trend following. And you can't make it a hybrid. It's like this has to be your core, and you need to follow it that way. Because if you keep taking these losses, yet you don't let your winners run, you're going to be having some serious losses. So it's important to have your winners run while you're taking these smaller losses. And you want that winner to cover those losses and actually give you a net positive as well. So love that. This is great. So we have should deliver long run positives, expected returns, key, should earn a material positive return during periods of growth and inflation driven equity drawdowns, which we've experienced, recently, and it may continue. Who knows what the future holds, but you'll be prepared and you'll be ready because you're trend following. Now, currencies. I got this directly from your website. I love it. I love how everything's outlined. Developed, emerging, and digital. And I take it that means you trade like the digital assets. Would it be Bitcoin and those type of cryptocurrencies?
That's right. We have Bitcoin futures and Ethereum futures. So that's
Ooh.
two out of 300 markets. So it's pretty small. And we have a couple, 5 or 6 or 7 of the equities that are related to the crypto digital world, miners and software companies that are involved with crypto. So we have a small little section, 5% of allocation to hopefully what becomes a new sector. Currency. I like to say in the future, currencies, commodities, stocks, bonds, digital, crypto, whatever the label is. I'm wishful thinking. I'm obsessed with diversification and with trying to reduce our risk and increase our opportunity set. So I formally made a sector out of those markets. So it's nothing radical, but yeah, the Ethereum and Bitcoin futures tend to be something that the hedge funds and old guys trade because we didn't know how to set up a Bitcoin account. But as soon as the CME comes out with the Bitcoin futures, we're like, oh, we're all over top of that. We can we trade futures there in the currencies, and so we can trade that Bitcoin. And Bitcoin is kind of like the ultimate, in my opinion, as long as it's liquid, as long as you can take a small loss, and it seems to behave just like all the other markets, but fundamentally, administratively. So, but it's like the ultimate trend following market because regardless, we've talked about this, but regardless of head down, following the trends, following the system, you have your opinions. You're like, I have an opinion. I don't think this trade's going to work because I have another opinion about things and the fundamentals in the economy. But we still follow the trends. And then with Bitcoin, like no one knows what the heck it's about. I don't. They have no idea where it's going. There's no fundamentals. So you can't even pretend to pay attention to fundamentals. You're forced to be so thankful that the only way you can get it into the portfolio is by following the trends and making it, a small part. And I think that's the problem with these markets. You were giving me this. You were saying something earlier. I thought about this. Rich would say, these markets can become your little friend. You can become loyal to them. You've been so long. It's brought you all this happiness and these profits, and you can really fall in love with it. And I think with some of these Bitcoin stuff, people became almost religious, and it was too much. And you had to only have Bitcoin. And if you didn't have all your assets in this, and if you didn't think it was always going up, and you would always only be long, but then here we come along, and we're like, I don't even care. I don't even know. It's diversifying. It's liquid. It's safe to trade. It's a future, which ironically, the SEC refuses to approve of a cash Bitcoin ETF. The only Bitcoin ETFs they have are futures-based Bitcoin ETFs. So for the first time in history, futures are deemed to be safer than cash. Kind of funny. So we're saying like, we're just going to use Bitcoin. We're going to be very rude and use it like we use all these other markets. We'll be long, we'll be short, we'll be flat. It's just part of our little game that we're playing with our numbers and our trends. And so, yeah, I hope it grows and I hope it stays safe.
Absolutely. Well said. We don't fall in love with these stocks or indices or markets or whatever. You trade them. And that's the key. It's not getting too emotional and attached to them. We can love our birds, right? I love those birds. They're so cute. They love you. They're just hanging out with you. I love it. They're so cute. What are their names?
This is Petey, and this is Banana.
Oh, I love it. She looks like a banana.
Yeah.
I love the yellow. She was the one that was fluttering in front of the camera before. I saw the yellow tail in front of the camera.
Oh, right. Sorry about that.
No, I love it. This is great. This is exciting. I have to ask you, any plans on getting a turtle in honor of turtle trading?
Well, we see turtles at our beach house every now and then. So we have some big turtles that we don't have as pets, but we admire them from afar, and at the beach house in Boca Grande, Florida. So
Very nice.
yeah, and we have a lot of turtle paraphernalia around. Birds and turtle knickknacks are
I
on our
love it.
shelves everywhere.
That's awesome. I think that's so great. I mean, turtle is very important and symbolic, and I love talking about the turtles. I love turtles myself, so so cool. And those birds are so cute. So commodities, we have energies, which have been very strong, and I think the demand is underestimated in oil and gas. Looks like it could be a strong year. And then we have metals and a gold last year, or was it earlier this year? Everyone was like, "Oh, gold's going to go over 2,100." We'll have to see what happens if it has strength again. Then we have grains, and then the softs. Could you tell us about that basket over there, that group of commodities?
So the grains are pretty mixed these days. A lot of things going on in Russia. Getting a lot of
Mm-hmm.
diversification there. They've been very choppy. It's been really helpful to trade a long-term approach and not get whipsawed around so much.
Yeah.
When you give back profits on you can see full force when you have a big profit and then your trailing stop is far away. You give back the open profit. But what you underestimate is all the whipsaws of in and out, and trying to chase these markets when really there's just noise and nothing's really going on. So that's really helped in the grains. Not a lot going on in silver and gold. They had a nice run up initially.
Mm-hmm.
Recently, they were late to the game and really not part of the game of protecting against inflation. That's another great thing about trend following, is that it was, maybe you think gold might help with inflation, precious metals, but if not, it doesn't matter because we have so many other things. Whatever is going to profit from inflation will be there. We just don't have to say, hey, it's gold. We don't have to have this opinion. I remember when I worked for Rich in 1984, we first got there, coming off of inflation, massive inflation in the 70s. He was like, yeah, it'll be the next, if we have inflation, it'll be the one things you don't want to be in is gold and silver. That was the last time. And so
Mm.
everyone's going to be focusing on gold and silver because that's what
Yeah.
worked last time.
Yeah.
So
It's
he
a
was
crowded
like,
trade. Mm-hmm.
it's a crowded mentality. It's in
Mm-hmm.
everyone's head. And so they're going to be, and so his idea was, I think if we get inflation, I'm going to buy sugar, or coffee, or something like that. So
So
it's just
smart.
this contrarian mentality, but really allowing you to be influenced by the trends. And you know what? If it doesn't make sense, so much the better. Um, yeah, I agree. Like you said, energy has shown some strength recently. The products, heating oil and unleaded, have been a little bit stronger. They may go up. One of the things I left out is a lot of the stocks that we have in the portfolio are commodity related. So we may have some stocks that are correlated to oil and gas. We'll get some diversification there. Sometimes the crude will go up more than the stocks, and sometimes the stocks will do better than the products, than the futures. Um, so, and then sometimes we access commodities, lithium, uranium,
Mm-hmm.
steel, um, that are not available in the futures markets. So there's another way to get some access, but we're predominantly 50% probably, um, you know, stocks that hopefully have some sort of tie-in with commodities, to where if we get a supply demand issue, shortages, supply chain, we'll see some movement in the stocks, not just earnings per se, but more of a good move in like you might see in a commodity. Yeah, so sugar. Oh, another thing we've had some good movement in this year are the meats. Cattle.
Mm.
Cattle's been good on the long side, long time coming. Cocoa, one of the tenets of trend following, unfortunately, is not only do we not kick out markets that haven't made money trend following in a while, and just nothing but choppiness and small losses. I think if you do some analysis, the back test says that you should favor those markets. Unfortunately,
Mm.
the worse it's been, the better it can be.
Yes.
So
Yes.
if you've got something with 10 losing trades in a row, that's probably going to be a better a better trade in the future than a market that just had a big profit and now you're looking to get short because you made it on the way up, you want to make it on the way down. So that's wrong-headed. And cocoa is one of those markets that probably every trend follower says is the worst market in the portfolio historically. So what did I do? I trade two cocos, London and US cocoa. Of course I do, because that's the stupidest thing in the world. Maybe you should consider getting rid of cocoa. It doesn't trend. That's silliness to me. There's no such thing as it doesn't trend. I don't care what it is. Markets go through periods where they don't trend. They go through periods where they do trend. They go through periods that try to convince you they have a personality, that they have characteristics that you can rely on in the future. I don't believe that. I believe cocoa may be the best trending market over the next 20 years, even though it's been the worst over the past 20 or 30 or 40. And I think that comes from a purely philosophical point of view of how trends work and how trend following works.
Wow. I love that. That's amazing. It's like a rotation. So with that in mind, now you've been using this strategy since 1994. Has it changed lately due to the changing environment that we're in?
Well, right now it's 50% stocks and 50% split up between currencies, commodities, and interest rates. I've never had 50% stocks before. But granted, I would say that a lot of the stocks have some commodity exposure or backing. They're sort of related to commodities. So I haven't really totaled up. If it would be sort of a discretionary measurement on to try to figure out, is it really a commodity? Is it going to really move with these commodities sometimes? Sometimes they will, sometimes they won't. All these companies have their own fundamentals to deal with. We have shipping companies, at some point in time after COVID, shipping was really
Yes,
amazing.
I remember
And
that.
lumber, we have lumber companies, we trade lumber futures. So we're getting some commodities, we're getting some diversification. But I haven't always traded 50% stocks. This is my latest creation, that stocks deserve it because I can find 150 stocks that are going to give me more diversification than any of the other three sectors. And they deserve because of that, the number of them. If there was, like I said earlier, if there was 1,000 or 5,000 commodities, I would make commodities 50%. And stocks would be smaller. But so I think it just was me getting the guts to do it, honestly, and to put this program together and think about it, about what I really felt was the optimal portfolio. And but no, it's changed. Sometimes, probably for the most of my career, I was maybe 25% stocks, currencies, commodities, interest rates. But for a lot of the career too, I traded some single stocks and I traded indices as well. So this is over the past 4 or 5 years, it's been the first time we've ever really tried to make trend following the best we thought it could be with the optimal portfolio, which would include a lot of exposure to equities.
Well, people love stocks. So yeah, your portfolio is 50% equities, and then the other 50 consists of about equal, I guess, a third and third, a third of this currencies, fixed income, and commodities.
I just hesitate to say, oh, we also have a lot of stocks that have commodity exposure, so we
Okay,
can
yeah,
count those as commodities as well. I think that's an overstatement, something that's not always going to be true, because I could definitely see a situation where, for instance, lumber is going up, and the lumber stocks are not, because we're in a
yes,
big bear market.
absolutely.
And that can definitely happen. And if it has never happened before, it can still happen.
Absolutely.
So, and I can see vice versa. The lumber stocks doing incredibly well, and maybe lumber not doing so well. So just know that we have trend following wrapped around all these markets. We'll have the right positions on eventually. And we're trading these methods that have proven over time that this is the best and safest way to handle these markets. If you want to build a portfolio of hundreds of markets and you don't know a damn thing about any of them, you can actually get them in your portfolio. Buffett and Munger, they are famous for saying diversification is the worst idea ever. It's the dumbest idea ever. And I think that is true if you approach the markets the way they do, which is, let's do this research. Let's buy these companies that we could think of them as our business. We don't want to have too much diversification because there's only so many good ideas that we're going to have. And it's a fundamental approach and getting to know these companies and making kind of this little prediction that we're going to get it right. And so why diversify? But systematic trend is like blackjack. We are playing hundreds and hundreds of hands all across the casino with an edge. And we want this diversification. We want to make these small bets. And whenever we lose, we don't want to lose very much on any single hand because we're spread out all over the casino and we have this edge, and it's a math edge, and it's a rule based upon the cards that we're seeing. It doesn't resemble anything like what they're doing. I don't think I could explain it to them very well to where they would agree with me. I don't know if anybody could, but I think both things can be true for our game, and it is a game, and it should be looked at as sort of betting. We're doing it the right way, and I'm sure that they're doing it the right way.
Yeah, everyone has their own way, I guess.
Yes,
I like this. Trend following is exciting. So you have fixed income, U.S. Treasuries, and global sovereign. Could you tell us about that?
Yeah, so we cover all the government bond futures in U.S., Canada, Europe, Asia.
Wow.
So that's pretty, all the ranges, the 2-year, the 3-year, the 5-year, the 10-year, the 30. I don't know if too many people know that there's a US 3-year. I just found out about it. I'm so excited. It's like having a new child. I found another one, and it's not as liquid as the other ones, but it does exist. And it's very correlated to the other ones, but we don't care about that, so we added it.
Very cool.
I got it from someone else. I forgot, probably Florin Court. They're the preeminent CTA trading 500 markets. So, but then we expanded a bit into some more fun stuff. There are fixed income categories where there are no futures, or the futures are not liquid. And we picked those up through ETFs. So we picked up TIPS, mortgage backs, junk bonds, corporate bonds. And some of those ones have long-term and short-term. So it's another little thing that Jerry had to do, pick up these and brag about it and be so happy that I have these fixed income ETFs that you can only trade if you trade securities, and they're all in these low-cost ETFs, mostly from BlackRock, of course. So I'm very excited about having those in the portfolio as well.
Exciting. And equities, that's the big part over there, about 50%. US and foreign developed, individual stocks and indices, and emerging markets. So tell us about that. Everyone's been talking about India, South America. I have a feeling you must have some of those in there, right?
Well, actually, I'm primarily stuck with US, Europe, Australia, and Canada.
Oh.
So I have not ventured out into China, Japan, India. But the thing of it is that it's a huge project it's really, for CTAs, I think, I get the impression when we talk about this, that they're very overwhelmed by this. It's so much easier to look at the 40-50 bonds or 40-50 commodities, 40 to 50 currency markets, and that's what we'll trade. We'll trade them all or a subset. But when you tell people, look, there's thousands of these stocks, now just go out and figure out which ones you're going to trade. Well, no, I need someone to tell me which ones to trade. I was going to say that it's kind of a risk to do your own thing and be one and try to be one. the only one who's doing something, because there's safety and comfort in being a part of the group. We all have similar performance. We're splitting up the money. No one's going to have crazy performance and we're all going to vol manage. We're all going to correlation manage. And here comes this weird guy who wants to throw stocks in and wants to let profits run unabated, wants to trade 50% stocks, for God's sakes. And it's fun and it's rewarding, but it needs to work. It's easy to start an ETF. And that's all we've done. It doesn't really take that much money. But to be successful, we're just beginning to do the hard part. And we're out there alone, no one has said they want this product. In fact, it's safer to do it other ways, as I've mentioned. And so we just have to see. And okay, so back to the stocks. There's so many to choose from, and I can't choose 150. It's just like it's really difficult because I'm leaving some off. So my gracious, I hope when I go to more stocks and I go into India and China, I can do that when I have a lot more money under management. So I'll need to pick up liquidity in other places, because of the 150 stocks that I trade from Europe, US, Canada, and Australia, there's another 150 I'd like to trade because they would offer diversification. They have great stories. They have great potential. But I also build them, without regard to historical performance and only for the amount of diversification they can add to the portfolio. But so that sounds awfully techie or quanty or whatever. But I also like to have fun with these stocks, and I have some stocks that make me laugh. And Tootsie Roll, Krispy Kreme donuts, I was sitting at the kitchen table one day and I thought, I wonder if there's companies that mine salt, and I wonder if they're public. So I found a salt company. We could just read you some of the descriptions.
I'd love to hear it.
Farmland, artificial intelligence,
Yeah.
coal, asphalt, drains, electric weapons, lumber, shipping. Oh, I have Bumble, the dating app.
Yeah.
Just for kicks. Water stocks, nuclear, eggs. There's the one company in the country it's a pure play, mostly pure play for eggs.
Wow.
Beyond Meat, marijuana, uranium,
That's
steel,
fun.
forklifts, cranes and forklifts. So yeah, all the positions in the ETF are publicly available on the ETF website. So people should get a kick out of
I'd love it.
The stocks we've chosen and the diversification.
Seems like so much fun, just like hunting for outliers. And that's what I'm going to call it.
Yes.
So cool. I love it. So much fun. So how do you determine your position sizing? Let's say you pick some of these stocks here. How do you determine how much you're going to allocate towards any of them?
Well, the ultimate goal is an equal allocation amongst all the markets. So they're all going to be traded equally using our formula that takes into consideration the recent volatility of the market. So
like we discussed,
we want, at least initially, each one of these bets to have the same juice and the same potential. So if we get a typical movement in a day for each of these markets, they'll each make about the same amount of money. That tends to stop happening once you hold on to a position for a while, because you either get out with a loss or the volatility in the market changes, and it can change dramatically. So you're hunting outliers. You're hoping that you're going to get 10% of the trades that are going to have really big moves, and they're going to make all the profit, and they're going to carry a lot of the volatility as well.
Excellent. Yeah, maximizing that expected value and keeping them about equal throughout the portfolio and for true diversification. And I love that. Now, there are also this ETF you have is great for tax efficiency. Since it's an ETF, you don't have to worry about the K1s and everything. Now, it's also optimized for behavioral economics, I like to call, but on your site, this is behavioral finance. So it helps people stay objective, and that's key. It's about objectivity and removing the emotions in the decision-making And like we said earlier, it's hard for people to take those small losses and, consistently. So tell us how it optimizes for behavioral finance in your words.
Well, we talked about a lot of that already. I think one of the things we didn't talk about was optimizing for stress.
Ah,
We don't want too much
yes.
stress.
Mm-hmm.
And one of the ways to minimize our stress is to make every trade, every decision very irrelevant. Each one of them is not very important. And so with 300 markets, 4 different systems, we're going to split up the capital into quarters and trade 4 different trend following systems. So each individual trade is not going to be hard to do because it's really not going to matter. And what matters is the loss. I don't have trouble. I didn't really initially have trouble taking losses, and I don't think people have specifically trouble taking losses when they have the position on. The problem that I had was putting the position on when I should, because I didn't want to take the loss later. I think this could be a loser. But once you get it on and it's a loser, I was like, yeah, let's get rid of that thing. When it hits the criteria, I'm all for getting rid of it. I don't want to keep it on there. And so that's another thing that stresses out traders. You've got 20 markets, or you're trading 10 markets. It's taken up a tenth of your capital. It's a big decision. And you've lost in this trade 4 or 5 times in a row. I really don't want to take another loss, in this particular market. It's a stressful situation. So by the mere fact we trade so many markets, multiple trend following systems, and we limit the losses and take small losses, then it's really not a difficult decision to sort of just do the trade. The downside is, when we lose money, it's usually going to be around 20 basis points. We're going to lose 20 basis points on a full position if all goes wrong. Now, you don't want to go crazy with that because you could have a lot of losers in a row, but honestly, that it's not something you're going to stress about. So I think that's important as well. You're in this type of strategy that taking small losses, letting profits run, letting profits turn into losses, never getting enough positive feedback about how good you are and smart you are, because you're always reminded that you're having more losses than winners. Let's at least try to make this psychologically not difficult to do. A lot of that has to do, of course, with, I think the most important decision initially is your overall risk budget. You're going to risk 20 basis points per trade, or 50 basis points, or 100 basis points. So if you're risking 100 basis points, you're trading a lot bigger than me. You're going to make a lot more money than me, but you're going to have bigger drawdowns. So getting to know yourself as to what's going to allow you to sleep at night and do those trades is super important. And you can't cheat and trade too large and tell yourself, well, if I start doing poorly, I'll reduce my positions quickly and start trading small again. That's not going to really work out for you.
Well said. Absolutely. The stress, it's always about what it costs you. And it's not just financial, but mental. And we don't want to have that stress. And it's about knowing yourself. Wise words. Thank you so much, Jerry Parker. Amazing. So honored to have spent this time with you and all of your enlightening discussions. Please tell our audience how they can follow you on Twitter and your amazing ETF.
So let's go to the ETF website, which is TFPN ETF.com. Blueprint Chesapeake MultiAsset Trend ETF. Unfortunately, too long, but TFPN is the symbol. And then on Twitter, we have fun with tweets, and everybody, the classic trend followers on Twitter. And then every Friday morning at 7 a.m. Twitter Spaces, X Spaces now, I guess.
Yes.
RJ Parker JR09. So that's fun too. And you can direct message me with questions and comments and criticisms. When you're out there with ETFs, you get criticism. I'm getting more challenges. I've got some smart listeners, and they catch me. He said, you said this, but you also said that. I'm like, darn, they got me.
You're so humble, so kind.
I like to, it's much safer just to go ahead and admit they got you,
Yeah.
and sometimes I say to them, y'all should have gotten me on this. No one said anything, but I said something that you should have caught me on. So, but people, Twitter is rough and tumble sometimes. So, but it's been fun so far.
Absolutely.
Thanks for having me. It's been a blast. I really enjoyed it. You're a great interviewer. You asked me some great questions. You let me ramble on.
I love it.
And I hope we can do it again.
Absolutely. I look forward to doing it again, Jerry. This has been amazing. And thank you so much for just doing what you do and not letting anyone tell you otherwise, and being so selfless and gracious and generous with your time and sharing with us this ETF, TFPN. And I'll remember those 4 letters forever. Plus nothing. Thank you so much.
Thank you. You're too kind.